One of China's largest property firms, Evergrande, may finally have been forced to liquidate after a decision from a Hong Kong court. We're going to take a look at what is going on there. And then today's Trading Takeout is going to be why FX trading is so expensive on Wednesdays. Like this video and subscribe to the channel if you want to get the best market commentary every single day right into your YouTube feed. So yeah, it finally looks like Evergrande has been ordered to liquidate in terms of their offshore business because a judge in Hong Kong has effectively said they have to liquidate. It says here that creditors couldn't agree on a restructuring plan and talks have broken down. While creditors are to support liquidation plan at today's hearing, the wind-up petitioner currently says he's not ready to push while the company proposes a new restructuring proposal this month. But I'd argue that's the way that it's going. Evergrande's CEO as well up here says that the group's operation is facing huge difficulties. Resources are limited and the preliminary voting of creditors has not met expectation, according to media. Now, I want to highlight this purely because it shows a considerable issue with our economies, whether you're a developing economy or a developed economy, you know, in the West. And of course, there are other economies like Japan who have faced these issues specifically to do with housing over the years. Now, the main problem with housing for me is that it comes down to almost the last person to buy something is basically the greater fool, right? You're buying something based on someone else taking it off you at a higher price. But the issue and the difference between housing and stocks, for example, is that housing is purely based on an expansion of debt. It's not really based on anything else, unless, of course, you go and improve the house massively, for example. That would lead to value increasing. But really, the expansion in the price of housing is based on how much more debt can be taken out. Whereas with stocks, it's based on, okay, has the company grown? Has, you know, they actually increased sales? Have they developed something? Have they been innovative? That is the largest difference. And of course, there's caveats to that as well. You know, with low interest rates, money is cheaper. So it means that stocks are going to get a bid anyway. However, there's a larger part of that is to do with innovation, producing more products, keeping up with things, competing, et cetera, et cetera. So there are big caveats, but of course, in China's case, they focus so heavily on housing and property at the behest of their stock market. If you look at, you know, any of the Chinese stock markets, they're completely stagnant. There is absolutely nothing exciting about Chinese stock markets at all. I'd say they're worse than the FTSE, and I'm a big hater of the FTSE. I think it's terrible how few tech stocks we have in there. And how little it's sort of grown, innovated over the years, apart from in the energy sector, of course. So we've got a fantastic energy sector that really does push the barriers on innovation, but that's not sexy. It's not, you know, it's not fun anymore. It's just really, really boring stuff. China, though, has loads of, you know, car companies coming out of it. They've got loads of other tech sectors, you know, e-commerce, that kind of thing, but still their indexes don't want to increase. And a large, you know, fact of this and a large component of this is to do with the political makeup of China. You know, the CCP over the last couple of years have been clamping down on leverage. They've been, you know, saying that ed tech firms need to downsize. They can't put out as many products. They can't put out as much content, etc. And the political situation definitely stunts Chinese equity market growth. I think it creates massive, massive barriers for further investment. And what we're seeing now, I think, is perhaps the Chinese say, well, you're committing to all of this stimulus, which they are, China, you know, in terms of monetary stimulus and also fiscal. But our equity markets aren't growing. Now, why is this? You know, we've got all of this tech, we've got all of these developments. We are the manufacturer of the world, and yet our equity markets aren't going up. Why? And then they're going to say off the back of this, okay, well, because our equity markets aren't going up, we have to put all of our cash into property. And then they're saying, well, why again? And it all comes down to what the government wants them to do. Whereas in the West, it's not necessarily like that. It's down to what interest rates really want people to do. You know, the cost of capital determines where capital is allocated. Perhaps inefficiently, but it's not the point. You know, people are free to decide what they want to do with their capital pretty much. And so this is, I think, going to be one of the most political issues coming out of China over the next 5 to 10 years is how is politics internally going to interact with the consumption or capital consumption of its population. People are going to be so much more averse to just going and buying houses as a wealth vehicle. You know, Evergrande had a ton of products that were basically spin-offs or derivatives of the property market. And so this was also creating, you know, even bigger issues. And so what I think we might start seeing is actually quite a loosening of capital controls in China. We already know that BlackRock are over there and Bridgewater, you know, in the corporate debt markets. I think this is what we're going to start to see. We're going to start to see a shift and a loosening of capital controls. And it's interesting because we're already seeing something similar occur in Saudi Arabia, not in the same context of capital controls, but we're seeing a context of a cultural change occurring in Saudi. And I think something similar might occur in China, but more economically focused and more politically focused, where Xi Jinping says, okay, I need to still keep control, but I also need to appease now. People aren't going to be going into property, which means that our government revenue is going to be down because we generate a hell of a lot through land taxation, not land value taxation, but land revenue. So a percentage of sales. So it becomes instantly a political issue. And this is why I think they're looking so quickly to resolve this. They don't want it to blow up because that is a massive, massive issue. And it's why comparing it to Lehman, you know, is completely different. Lehman was allowed to go under. This won't be. They'll be forced to liquidate and there'll probably be arrests and things like that. But the government is basically going to backstop the people as much as possible. However, they're going to have to look at the next cycle and say, okay, are there the same risks? And I think that is what we will see. We will see considerable amount of capital relief entering into Chinese politics, into Chinese economy. And we're going to be able to see a more liquid economy. And, you know, if we do see that, a strong bet would be on Chinese equities. They're absolutely battered at the moment, lowest PE in years. I think they got a price to equity of price to earnings of 8, which is insane when you consider the S&P 500 is at 25, right? Which doesn't necessarily mean that it's overvalued. It's just pricing in future growth. I think when people see price to earnings, they think that it automatically means that it's completely overvalued, when really it's just actually showing quite a strong market and people believe in the market, which is good. But yeah, that is the illusion that I wanted to make there with Evergrande being wound up potentially. Looking very likely, and future economic issues with China and how to sort of understand the links and connects, because making sure that you keep these themes at the forefront of your mind is key, because then it allows you to weave certain stories and narratives together. Why is FX trading on Wednesdays so expensive? If you're relatively new to trading, you might have noticed sometimes when you hold a position overnight on a Wednesday, you're hit with big fees and you see a big dip, not necessarily a big dip, but a dip basically in your P&L on your unrealized position, your unrealized P&L. And this is because FX is settled in something called T+2. So FX settlements occur actually 2 days after the trade is closed or entered, however you want to think of it. And so this means that on a Wednesday night, you're actually accounting for the weekend as well, whereas on other days, you're only accounting for one day. And so this is something really, really key to note if you are looking to hold longer term positions, especially in more exotic pairs, because you can start to get hit by relatively large, if you like, rollover or interest charges. So it's absolutely key to make sure that you do understand this so that you can account for this more psychologically than anything. but also to make sure that your broker isn't completely doing you over on it, because some brokers really like to manipulate this and like to interpret the fact that people don't understand this as being something that they can use to their benefit, when in actual fact, they should not. So make sure that if you are getting hit by any undue charges, you check what the industry standard is. There's various different sites that you can do this across, and ensure it's not impacting your trading directly.